Welcome to the weekly update, where I'll go over the action in the market for the week of April 15th through the 19th, and then we'll see how things look for the week of April 22nd through the 26th. We saw one of the more negative weeks than what we've seen in quite a while. This is probably the most negative week of 2024. A week ago, I made a series of videos talking about we were converging, and if ever there was a time for the market to make a stand, we saw this across not only the S&P, but across different indexes, different sectors. Everything appeared to be coming together, that we were going to find some support and then be able to bounce up off of that. There's only one problem. We didn't do that. We ended up falling below all those levels of support, and then that fed into more selling. And right now we're seeing a shift where when I do the daily videos, we are negative in the short and intermediate term. The long term on the daily charts is still positive, and we're still positive here too, but we're seeing some pullbacks. We're seeing some doubt being created. It seemed like just automatically the market was going to go higher. Well, this week really came to show us that we might ultimately turn and go higher, but there may be some bumps along the way. Before I get started, please know that I do a video every day. And if you really want to keep in touch with what's going on, that's the real foundation of my analysis. The other videos that I do, this weekly video, an intermarket analysis video, I do a deep dive video, and then I do a what to watch video. All those are like peripheral types of videos. The foundation of everything that I do is the daily video. So if you really want to see what I'm thinking and what I'm seeing and what I'm commenting about, watch the daily videos. I know they're longer. I know people are busy. I try to keep them at about 30 minutes. Unfortunately, I've been going over that, between 30 and 40 minutes. But if you have thousands, 10,000s, hundreds of thousands, millions of dollars on the line, and you're kind of concerned about things, see if the videos that I offer on YouTube and on Rumble will help you in your trek to manage your portfolio. Also, I'm in this series. I'm in the process of doing a series of program launch videos. I have a whole program. I not only do these videos that I post on YouTube, I have courses that I teach. I have portfolio and trade and investing ideas that I go through. There's communication back and forth where we can talk within a group. You have an opportunity to have one-on-one conversations with me if you feel that will be helpful. That's the whole program. And I'm launching a series of videos that just talks about the different areas. And I hope to be launching this in June. I've got a lot of work to do. I have websites to build. I have curriculum that I'm in the process of developing and re-recording and all of that. So it's quite a process. And I'm just one person doing all of this. So it takes a lot longer than what you would think. Also, for every video that I post on YouTube and on Rumble, there is a PDF that I make available in the description below that video. Some folks find this helpful to download that. You can look at these slides. You see the same slides that I have right here, and also the charts that I go through in each of the videos. And then there's a newer video that I just launched in 2024 called What to Watch. The other videos, and then the last video, so that I have the daily videos, weekly intermarket analysis. Then I have a video called a deep dive video where I talk about some charts that I really didn't cover all that much. Then the very last video now is called What to Watch. This is what I'm really honing in on. And it's going to be different this week than what it was a week ago. I was really watching some things a week ago. Well, the market has shifted, and now there's some other things that we'll be watching. I go through some positive things and then some negative things in that video. Also, every day there's a thing called pivot points, and these last for the whole month on the daily chart, where they change each day on the intraday chart. They're posted on the community tab on the YouTube channel. I can't do this on Rumble. I don't have that capability. Some folks find this very helpful. You would be surprised, especially the intraday pivot points. Just when we're going up, we'll stop right at a pivot point. When we're going down, we'll stop going down right at a pivot point. It's really amazing how those things work. I do have a private Facebook group, not really active. I'm the only one that posts there, and I only post every time I upload a video. I'm probably going to be morphing this into something else that'll go in conjunction with the program. I already have some questions posted. I'll be going through the poll from the previous week. There are some new questions for you to ponder for the upcoming week. And then I'm really careful about YouTube and Rumble comments. It's slowing down a little bit, but I've been having these folks come in and post these comments, especially on Rumble. They talk about how they're a YouTube genius and how my channel is just losing and it's terrible and it's failing and all this stuff. And they have all these answers. Well, I just delete those comments. If you want to have an honest back and forth with me, I'm totally okay with that. If you want to keep it private, at the end of every video, I put an email address on there. So it's up to you if you want to have communication with me. But any communication that we do have, I want it to be legitimate. I don't want it to be garbage comments that come on there. And I do have a link here at the bottom where I post videos on Rumble. Every once in a while, I'll have some uploading problems. And if you can't find me on YouTube, go over to Rumble. If you can't find me on Rumble, go over to YouTube. It's been working pretty good lately, but this can develop problems out of the blue. All right, let's go back and talk about this past week. For the week, we were down 3.05% for the S&P 500 on below, actually, it is below average volume. We spiked up a little bit because it was options expiration. And so that day was kind of a day all by itself. That was Friday's session. And that's when we also saw a pretty big down day as well. We're positive right now with our charts, but we're showing a lot of weakness and we're breaking through some support. And some of our indicators are starting to kind of roll over a little bit. We're wondering, is there some kind of a shift going on in the market? Are we rotating from one group of stocks into another group of stocks? By going through all these videos that I post, hopefully you'll get a bit of a handle on that and really get an idea of where we're at right now. But longer term, even on the daily charts, we're still positive in the long term. And we're still positive here, but we want to keep an eye on things. It probably got to the point where the market felt, I know it's like the market's not really a real thing, but it doesn't like to be taken for granted. It doesn't like to be treated like a cash machine. It'll let you do that for a little while, but eventually there's a reckoning day. Well, we seem to be going through that right now. We don't know how much more of it we still have to go, or if it's even going to turn worse than it already has been. Now, you have people that are what we call perma bulls. They always have the positive outlook, and we always should have a positive outlook. But there are times when the market goes down. That's just a fact of things. And they think everything's still going to be just fine. And who knows, it might be. Then you have the perma bears. No matter what happens, we're just around the corner from a crash. If stocks go down 0.5%, they call that a crash and everything's falling apart. And you might as well close the stock market. It's going to be done and they're going to lock the door and you're never going to be able to do it again. And they might be right. But I try to come in the middle where I try to be a perma realist. There are times when the market goes up, and that's about 70% of the time historically. But there's also about 30% of the time when the market goes down. And that's just a fact. And there are ways you can take advantage of all those different environments. Okay, as far as our trend, well, let me get back up here to this other point. We had some real geopolitical things happen this past week. A week ago, there was an assault on Israel from Iran. The first time in history this ever happened. They were like, the numbers are different. I heard anywhere from 200 to 350 rockets, drones, and things sent from Iran in various places. And 1%, like 4, ended up actually hitting something and it really didn't do any damage. Well, Friday, Israel decided to retaliate and they flew all the way over to Iran and bombed a couple of places. And now we're wondering, is it good for right now? I mean, it's never going to be good. These guys have been really battling each other for decades and in some ways thousands of years, but is it going to settle down for right now? Is it going to stop having an impact on the market for right now? That's really what we want to be concerned about when we're dealing with the stock market. We had some Fed speak come out this past week and it didn't really calm the markets. If anything, it kind of added more jitters. We are starting to see a weakening trend with the ADX. This is the average directional movement. This is what I base whether we're in a trend or not in a trend. If we're in a trend, then I implement one kind of strategy or different trending type strategies. If we're not trending, then I implement different kinds of strategies. So that's why this is really important to keep an eye on. We are starting to roll over after we've been positive for a long time, pretty much going back to last October into November of 2023. It's still positive though. The green line is on top, but it's starting to roll over, and I'll show you that chart. Here's just some bullet points for the week. The stock market had another down week, but the Dow actually ended up finishing unchanged. It had been a little bit weaker as the market was going up. Now that the market is going down, the Dow is actually holding up a bit better right now. But the Dow's only 30 stocks, and this can be heavily influenced by earnings reports that come out, and that's pretty much what happened. Mega caps and semiconductors underperformed this week. These are the areas, if you remember way back to October 2022, if you were watching the market at that time, it was the semiconductors that we saw a moving average crossover first. They were the first area to turn back positive, and then everything kind of followed after that. Now, we're still positive with the semiconductors, but the semiconductors and the mega caps, the Magnificent Seven, they've really been leading things higher. Well, now that we're under some pressure, they're leading things lower. So you love them when you're right and they're going in your direction, but these can really become your enemy when they start going against you. NVIDIA, this is one of the darling stocks. It's still up over 50% on the news, but it was down 13.6% this past week. I say this just because everybody should have a real respect for the market. But when you have folks that don't know what they're doing, they've heard of this thing called NVIDIA, and they heard they can make some quick money doing it. If they buy it, it's automatically going to go up. It's like Bitcoin. It's like the .com stocks. It's like all these manias that go back hundreds, some even thousands of years. People are always looking for a chance to make a quick buck. Well, NVIDIA has been kind of riding that wave lately. And so you have people downloading these apps that have no idea what they're doing, and they're just buying it. And then they see it fall a little bit. Ooh, I'm buying the dip, buying the dip. Well, it dipped 13.6%. And so some of those folks that got in recently, they're suffering some pretty big losses right now. And there really wasn't any news around this. It was more of just a pullback that kind of got going. And then there's this other attitude or thing that's really taught by lots of people, and some very smart people and some very successful people. I don't teach it and I don't agree with it. Buy the dip. What's a dip? When do you buy? When do you know the dip's over? A lot of people were buying the dip, and it looked like when we were converging on things a week ago, that would be an excellent place to buy. Everything was coming together. We saw no confirmation on price. We ended up falling below that. And now, instead of getting in at a good price, you have a lot of people that have losses. I don't like this idea of buy the dip, but there's a lot of people that would disagree with me on that. And if you're successful at it, my hat's off to you. I like to buy into strength. So if I want something to go up, I only buy it if it's going up. If I want to sell, I sell into weakness. If I want something to go down, I sell it when it is going down. I don't try to front run these things because there's no real definition of buy the dip. What does that mean? It can mean 20 different things to 20 different people. And it did not work this week, and a lot of people are getting burned because of it right now. Some Fed officials did come out and they say, we're not in a hurry to cut rates. What's the big rush? Because recent inflation reports have not given us enough confidence that we're able to get down to that 2% target that we're trying to get to. And the market didn't like this. They pretty much have figured, okay, there's going to be 3 rate cuts, according to the notes from the last meeting. And Chairperson Powell kind of confirmed that. And the economic reports seem to be going that way. Well, now we're seeing a real shift, and the economic reports are stronger than expected. Inflation might be making a comeback, and that's why we're seeing some shifting going on in the market. And so this idea that the Fed is automatically going to start cutting rates, it's not so automatic anymore. There's even doubt that we may get any rate cuts in 2024. If we do get any at all, it might be in 2025. And if these economic reports come in stronger than expected continuously, they might even have to raise rates. Okay, interest rates were up on the week. We closed at 4.62% on the 10-year yield, and the dollar was also up. It's still going up against other currencies. Both of these together are putting pressure on stocks. Typically, stocks go up when interest rates go down, especially small caps, because they have to borrow so much. And then the dollar, the market tends to like a weaker dollar. That helps the exchange rates work more towards a company's favor, the import-export exchanges and things that go on. So when the dollar is really going up, that can pressure stocks. And then geopolitical tensions that I talked about in the Middle East. And this could re-escalate at any time and get even bigger than it's already become. So we just want to keep an eye on those things. Plus, I mentioned this in the daily video. This upcoming week is Passover in Israel. And that's like one of their biggest days of the year. And there's some things that are going to be going on that could be happening around the Temple Mount. And that's a very controversial place anyway. And if things get out of hand, that could really start to explode into something pretty quick. So we'll just be watching to see what's going on there. Here's the week. The Dow was unchanged on the week, where the Nasdaq was down 5.5%. The S&P was down a little bit over 3%. And the small caps, as represented by the Russell, they were down 2.8%. This is a chart that I've been showing for almost a year now, just because this is a very long-term chart. The blue line that you see here goes from 1966 to 1982. And we kind of have been following this gold line. This is what inflation has been doing. It generally has been declining. Now, that doesn't mean that it's going to go straight down. Even during this period in 1976, we saw some bumps up, even as it was going down. Are we going to continue to follow this? And if we were to update this chart, we would actually be coming down a little bit more from where we were at when I started showing this chart. That's one thing to keep an eye on. The other thing to keep an eye on is look what happened after that. This is when we saw hyperinflation. Actually, it was stagflation, where we saw massive inflation with no economic growth. That was the mid to late 70s. And then things didn't finally start to get under control until we got into the 80s. This is Renmac. This was posted on Twitter months ago, where they did a lot of research and found that anytime we're above 4.02% for the 10-year yield, that's when it starts bumping into corporate profits. And right now we're at 4.62%. Here's the poll results from a week ago here, where I asked, do you feel stocks are pulling back and will bounce? That a more significant decline is underway, or that stocks will remain range-bound and little changed in the upcoming week? Now, remember, this was a week ago. Well, 29% thought that we were going to pull back and then bounce from that. Well, we didn't do that. A more severe decline. That's what ended up happening, where most of the folks thought at that time that we were going to be range-bound. Well, we didn't really stay in the range. Then I also asked, interest rates continue to climb, and they're still climbing right now. In the upcoming week, do you feel that they will rise, remain about the same, or fall? 60% thought they will rise, and that's what happened. Where 10% thought they would fall, 30% thought they would stay about the same. Then the dollar has been rising, which can often put pressure on stocks, as I talked about. In the upcoming week, do you feel the dollar will have a big impact or a minimal impact? It had kind of an impact, but 71% thought that the impact wouldn't be all that severe. It ended up being kind of significant, but then there's a lot of other factors that play into that as well. Then as of April 12th, again, a week ago, there is solid support at or slightly below current prices on the S&P. This is what I was talking about with the convergence all coming together. We saw it on the S&P, the NASDAQ 100, the Wilshire 5, it's not the Wilshire 500, it should be the Wilshire 5000. And across other indexes, other sectors, on both the daily and weekly charts. You don't get a convergence like this very often. Do you feel that these support levels will hold, or will they be broken? Everybody who voted thought they would be broken, and that's what happened. Here's a chart that I've been referring to for quite a while now, where if the Fed is able to come in and cut rates, because you often hear this idea, well, when they start cutting rates, that's when stocks go down, because that means the economy is weak and blah, blah, blah. There is a time, and if you go back and look at history, there's a time when interest rates can be low or even going down and stocks still go up if the Fed is allowed to adjust rates because of what's going on in the economy. That's called slow cycles. And they just adjust things, kind of tweaking things here and there. And that can be very beneficial for companies, which ultimately are beneficial for their stocks. Now, if we get hit with something, some kind of catastrophe, some black swan event, something that we didn't see coming, and then the Fed has to cut rates because of that, that throws us into another ball game, and that ends up being negative for stocks. And we don't know. We can only go with where we're at right now. knowing that before 9/11, there was a 9/10. Then we look at earnings. The projections are still looking good going out, which does justify stock prices going up. Then what's the biggest tail risk, or what's getting in the way of stocks right now? As of this chart, inflation has come back to be a problem where it pretty much had kind of gone away. Now it's starting to become an issue again. Geopolitics, these are the things mainly going on in the Middle East. The US election, they're a little bit worried about that we'll have a hard landing, that there'll be some kind of credit event like banks collapsing and things. And then China, not very many people are worried about that, but it still made the list anyway. And then expectations for bond yields to fall now lowest. And I don't like this. October 2022. It's like, look at the context. What were we going through at that time? We were actually going up at that time with bond yields. And for us to come say, oh, it's the same as what it was then, it's not an apples to apples comparison. But they do this all the time. And the financial media loves to do this. Where this is, do you feel interest rates are going to fall? In December, a lot of folks thought that. Nah, people are not quite so sure at this time. Then this is kind of a convoluted chart here. There's a thing called buybacks where a company will go out and buy back their own stock, and that can be beneficial. It can help the stock price go up because there's fewer shares on the market. They have to come in and buy those shares, so that can also pump up the price. And a lot of times they have millions, hundreds of millions, if not billions of dollars to do this, and that can really give support to stocks. And so this kind of takes a historical look at where are we now, where there's a big impact. This is changing. What impact is this having on stocks? Well, it's changing their PE ratio, because sometimes that can actually help their earnings. Yeah, it's a little cook in the books, but everything we look at is manipulated. Doesn't mean it's fake. It just means it's manipulated from the economic reports we read to all the information that we get. But this is what the market uses, and so we have to go with it. And just pause this and see if you can get anything out of this to see if this would actually give you any insight. It's kind of convoluted, in my opinion. Then the belly of the beast. This is growth. This is what's really been fueling things. Since we started going up in late 2022 and into 2023, this is what's really been marching higher. Now we're starting to see a pullback here. And if you want to see more of this kind of study, look at the intermarket analysis video where I do a real kind of in-depth comparison between growth and value. FactSet just had one blog post. I thought they'd have more since we're kind of getting into earnings season. This is just an update. And the part that I'm just going to go through is I underline it in red because I get all this blah, 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 blah stuff that really doesn't help us. As of Friday, 14% of S&P 500 companies have reported. All right. Of those that have reported, 74% have been above their estimates. Okay. And then they get into all this, which is above the 5-year average and equal to the 10-year average. Okay, just know that right now earnings are coming in pretty good, but that doesn't necessarily mean anything. You can have a company come out with an earnings report, they beat estimates, they beat forward projections, and it just gets hammered. Okay, you can have another company where they don't meet their estimates, they don't have a good outlook, and people start buying it. That's probably not as common, but just because they have a strong earnings report, you get a real reaction to that, and it can actually go against what you think would happen. Here's our charts. We'd start off by looking at the intraday chart, where, yeah, we pretty much spent the whole week going down, down, down. We were down on Monday. We're pretty much flat on Tuesday. We went down some more on Wednesday. We saw a little bit of hope here on Thursday, only to give that up and close lower. And then things really started to get negative as we started to fall in Friday's session. So for the week, and this is just the 5 trading days of the week. If you go from Monday through Friday, the Dow was up 0.67%. Friday to Friday, it was unchanged. All the other indexes ended up being down on the week, with the NASDAQ and NASDAQ 100 being down the most. They're the ones that have been up the most. So now that they're getting hit a little bit, they're going down the most. This goes back to the beginning of the year, and a week ago, I made a mistake on this chart. I hope I have the right one here. All of the indexes are up except for small caps, going back to the beginning of 2024. Sectors. First of all, I rank this according to the percent change, and we were down, so I ranked this by what was down the most, and then we get more positive as we go down. We had tech, communication, and discretionary. These have been the stronger areas. These are the areas that have really been leading things higher. Now, discretionary bailed 6 months ago or so, as Tesla started running into problems. But the tech sector and communication, that's where you're getting a lot of the strength from. That's where these magnificent seven stocks are located, are in these sectors. They got hit hard this week. And then the areas that were up, we had utilities, financials ended up being up, and then energy, which has been stronger lately, and staples. Staples tends to be more defense oriented. Then on the next chart, I go over to the right-hand side and I look at a thing called a scooter score. And this says, how strong is this sector? And they put a number to it. The higher the number, the better looking that particular sector. Right now, we have the financial sector, communication, industrials. Those are in the 90s. Then we have some other ones. And the two weaker areas are discretionary, a la Tesla, and real estate, because interest rates are going up. And so it's harder and more expensive to get a mortgage. So real estate's been under pressure. This is a thing called a relative rotation graph. And I usually like to remind folks, think back to your geometry class. When you have a line going from left to right, that's an x-axis. When you have a line going up and down, that's a y-axis. And when you're over here on the right-hand side, up in the right block, it's not really a square, it's more of a rectangle. This would be plus plus, and these are the areas that are strongest. And you can see we have things like industrials, the financials pulling back a little bit, but still looking pretty strong. And communication has also been showing some weakness as of late. Then over here, when we look at the lower left rectangle, this is the minus minus. These are the areas that are quite weak. And you have real estate. Some areas like utilities and even energy, they've been showing some improvement. Now, this goes back a year. It doesn't go back a week. It goes back a whole year. So it might be a little bit misleading based on what's actually happening right now. Then I also go back a year and I look at how are the indexes doing, and I compare it with the Wilshire 5000. And we have the OEX, which is the S&P 100, the biggest stocks that make up the S&P, then the S&P 500. And now we've got the mid caps. They're still hanging in there pretty well. They started getting strong in late January of 2024. Yeah, they're pulling back with everything else, but they're holding up better. And then you have utilities, which are showing some improvement, but have been very weak. And then you have the small caps, which have been a real disappointment. And you have the Dow Jones Composite Average, which I'll go through. This is the Dow, the transports, and the utilities together. And the transportation, that's also looking weak right now. So going back just for the 5 trading days, we did have a number of sectors that ended up being positive, where it's easier to focus on what was down, where we had tech, discretionary, and real estate were down. All of the other sectors were up for the 5 trading days. And we go back to the beginning of the year, where we still have energy, communication, financials, and industrials. They are positive on the year, with the other sectors being negative. Sentiment. Man, it seemed like not so long ago, the market was saying, let's party on and keep going. We're down at 31 right now. To give you some perspective, when we get above 75, that's when we get a little too positive. There's real complacency in the market. Folks are starting to take the market for granted, and it'll last that way for a while. Well, this time we broke, and when we start coming down, this is when we use this as a contrarian indicator, and as it's going down, we ride with that. Now, if it starts to drop below 25, that's going to be an extreme negative reading, and if we start to bounce up out of that and show some improvement, that's when we use this as a contrarian indicator to the positive side, but we're not there yet. The active asset managers, they have become really, really positive on things. They're really pulling back now. There's the same chart showing how we were well over 100. Now we've come down to 62.98. If we look at the VIX, this thing's just shooting up these days. We were just showing that there's not a lot of fear. Well, it's really shot up. Here on the bar chart on the bottom, it shows that there's just not a lot of fear in the market. Well, now suddenly that's changed. And even in Friday's session, this is the bar chart. So this shows the movement intraday or intra-week. We actually shot above 20 for a little while there. And that's when things can get really scary, when the VIX goes above 20. The Ulcer Index starting to turn up. We're seeing a little bit more pronounced move up with the daily chart. And this is the Rydek Bear Bull ratio. When this is going up, that means folks are really bearish on the market. And when this is going down, that means they're really bullish on the market. Well, this only goes as of Thursday. So this is probably going to spike up as these folks, they have jobs, they're busy, they have families, they have things to do. So they tend to react to what's already happened. And they get home and they say, oh my gosh, the market was down. Okay, I'm going to log into my Ridex account, get out of the bullish fund, get into the bearish fund, only to see us have a big up day after that. And so a lot of times they're doing the opposite of what they should be doing. But we keep an eye on this nonetheless. This came out a few days ago. This is Investors Intelligence, where we had a very high reading at almost 4.5. We have dropped down a little bit under 4. In the upcoming week, we're probably going to drop a lot more as the market experienced some weakness. The latest reading from the American Association of Individual Investors, and that's what we are here, they're not as positive on things as they had been. But the red line, which is the moving average, it's still continuing to go up. This chart is still positive, believe it or not, even though it's going down with the black line. This means that the tech sector is outperforming cash. Yeah, we're hitting some difficulties right now, but we haven't really changed the whole environment of this chart, at least yet. But we want to keep an eye on this, because when we really started to go above this cloud and get above all these moving averages, this was 2022, and that was not a good year for stocks. Looking at the economy, we had the latest reading from GDP now. We're going to get the first advanced reading of GDP for the first quarter. That'll be coming out in the upcoming week. And right now, they have us just a little bit under 3% for GDP. So that's positive. If you look at the forecast, we're at about 2 3/4 to the upside to about 1 1/3 to maybe 1 1/4 to the downside when they survey economists. This is looking at it a little different way. The takeaway from this is everything is still positive across the board. And because if we start to go negative with GDP, that's when we're starting to go into a recession, or we may already be in a recession, and that this will be confirmed by this chart. When we look at the spread between risky and not as risky bonds, we ticked up a little bit here, but we're not shooting up like we have other times when the market really ran into some problems. So we're not really seeing any danger signs as of yet on this chart. The latest reading from the financial conditions that are come out of the Chicago Fed, I believe it is. I know it's Chicago, but I guess it is the Chicago Fed. We're below this black line. When we get nervous is if we go above the black line. This hasn't been updated since the 5th. This is above the black line, but still below the red line. So that's still okay. The smooth U.S. recession probabilities going up, but still below the red line. The bread butters coming down in the latest reading that was updated on April 1st. Keeping an eye on inflation, we're going to get GDP, and then we're going to get the core PCE coming out in Friday's session. And so this is going to adjust, and these change pretty much every day according to what they think inflation will be. What's the Fed going to do? They have a meeting coming up on May 1st. As of right now, there's a 96.8% chance that they're going to leave rates unchanged. The market is predicting 5.25 to 5.5, and that's where the current rate is at. Because see how this has changed over time. This is, if anything, getting more locked in now. This blue, this is where we're at right now. Then we go a day ago, a week ago, and a month ago. So these percentages have been going up. And barring some kind of event that changes this is probably just going to get even more locked in. Now, we also look out to the meeting after that. We go to June 12th, where there's now an 83.4% chance that they're going to leave rates unchanged at that meeting too. Okay, back at the beginning of 2024, they thought, March. Okay, that's not going to work. How about May? Well, that's not going to work. How about June? Okay, they're just having to keep pushing this out. And to see how this has changed, here's where we're at right now, that rates are going to be unchanged. A day ago, a week ago, look at where we were a month ago. The market was really starting to think, they're going to start cutting rates. Well, that has shifted as the economic reports have been stronger than expected. Looking at the Fed balance sheet, it's going up just a little bit here when we look at it over the past week. I haven't heard any, if you've watched these videos before, I was hearing some rumors through people that seem to really know what's going on, that maybe the Fed's going to come in and do what's called quantitative easing, because they're quantitative tapering right now. They kind of hinted that they're going to stop doing that and possibly come in and start buying, which would be a form of quantitative easing. I'm not hearing that anymore. Things have kind of fallen back from that. Then looking at the year over year change, where we are still declining with the Fed balance sheet. So things are still dropping off. Looking at our breadth, yeah, we came down based on price and volume, but we're still above this moving average. And we're showing some weakness on the daily charts too, a little bit more weakness, but for right now, this is holding up. When we look at the new highs, new lows, holding up okay on the daily charts, where we're going down with the 4-week and the 10-week moving average. But you look right here, the last week, yeah, we didn't see many new highs, but we really didn't see an expansion of new lows either. So we're kind of in between right now. The advanced decline ratio actually ticked up a little bit. We're above 0 and going up, okay? And we're seeing this on some of the daily charts. The last couple of sessions, Thursday and Friday, we had down days, but the indicators are starting to turn up just slightly. Accumulation distribution, this is the smart money. We're below the moving average and declining on the daily chart. We're declining, but still above the moving average here on the weekly chart. Our trend, this is when I talk about we're starting to show a weakening trend. We're coming down and dropping below the moving average. This black line is the ADX, average directional movement. That's the basic indicator. I put the moving average on here just to get some context of direction. When we drop below this, then that tells us we're still trending, but it's a weakening trend. And then we say, okay, is it positive or negative? Well, which line is on top? The green line. So we still default to positive on the weekly charts, but we are really coming down and the red line's coming up. And we now have a confirmed negative trend, both in the short and intermediate term on the daily charts. Here's the Erin indicator. The green line measures buyers, which fell back. The red line measures sellers, which according to this is still decreasing. So we're still looking positive here, where we've turned negative on the daily chart. The mass index is not generating a signal. Here's our daily chart. Looks kind of scary, kind of like, whoa, look out below. The perma bears are just loving this. You know, they're just thinking, bring it on. We dropped below this 50-day moving average. And right now, we just have to see if we're able to find some kind of support. We're not too far above the 100-day moving average on the daily chart. If we fall down, maybe that will provide some support. And then we're negative across the board according to the Keller market model. When we look at the S&P, mid caps, small caps, and NASDAQ 100, the only change on here when we go across the market is that stocks are negative in the short term. We've been that way. We're negative across the board when we look at bonds based on price, and we switched over to positive in the long term with commodities. No change here with the decision point scorecard. We're negative in the short term, positive in the intermediate term, and mixed in the long term. And we're coming down. Yeah, you can't deny that, but we're still above the midpoint of this trend channel going back to 2009. This is the chart that I was really focusing on. We broke below that. We had been maintaining price above this R1 level. It took us a lot to get through it, and then we were above it. And now that we came down and broke down below that, right now, this test has failed. And if we do start to go back up, is this going to provide overhead resistance again? So for right now, this is turning more negative. But when you look at our trend, yeah, we're pulling back with the black line. That's price, but the moving average is still going up, the 50-period moving average. And we're dropping below the 13-week moving average here, but we're still in an uptrend with the S&P 500. We're starting to bounce up a little bit with the McClellan oscillator. And we're seeing that on the daily charts too, even though we had a down week. And this is giving us an extreme negative reading. The summation index, we are declining, but still above 0 based on price. We've fallen below 0 based on volume. So it's a mixed picture, looking a little more negative there. We're also declining with the Swenlin trading oscillator. We're below 0 and declining based on price and volume. That's negative. The bullish percent index, we dropped below 50. This is also negative. One of the reasons I really like this indicator, it's not moving average based. How this is calculated is all the stocks in the S&P 500, are they generating point and figure buy signals or point and figure sell signals? They were generating an awful lot of point and figure buy signals. Now we're starting to see more sell signals being generated. When this drops below 70, that's actually a sell signal. When this drops below 50, we've actually turned more negative now. And then looking at our momentum, we're rolling over with the PMO. We had been looking pretty solid, but now we're starting to go negative based on price and volume. When we break those out separately, we're showing a little bit of a bounce here with the PMOs that are rising, and even though we had a down week, and we're seeing this on the daily charts too, we're still declining with the buy signals and looking extreme negative, where we're actually declining with the PMOs above 0. The Bollinger Bands, there's a lot of different ways you can use this. The one that I focus on the most is called the percent B, and that's when we close above or below one of the Bollinger Bands. We actually spent 2-3 days, I think, either 2 or 3 days below the lower Bollinger Band on the daily chart. And then after Friday's session, the line was able to move enough so we're not looking extreme. But we're right at a midpoint right here. We're coming down to the midpoint here on the indicator, and that's why we're getting a reading pretty much at the midpoint down below. So we are looking more negative with slope. We're rolling over with the TSI. These are our shorter term oscillators. Now our intermediate term oscillators, the MACD, the PMO, and the PPO, they're crossing over negative. We're still looking positive, but showing a little bit of weakness here with our long-term oscillators, the TRIX and KST. Chaikin money flow. This is a smart money indicator. It's negative on the daily chart, showing weakness on the weekly chart. We're declining with the Chaikin oscillator. We're negative on the daily chart. The force index is negative on the daily chart and extreme negative, where it's now turning negative here on the weekly chart. And we're pretty much flat with the money flow, but after giving us an extreme positive reading, it has been declining, but it's still above 50. And we had the down week here, and that's a pretty significant move. We're starting to roll over a bit when we go back 50 weeks for the rate of change. After getting above this red line, now we're starting to come back down. RSI, this is what a lot of folks use as an oscillator. We had an extreme positive reading, and now we're starting to drop down from that. That's, for some folks, would be considered quite negative. We're still negative with the weekly chart of the special K. We're rolling over, but still positive on the daily chart. The Stochh RSI is extreme negative. We're down a bit here with the Williams percent R, dropping below 50. That's the midpoint. We're also dropping below 50 with the ultimate oscillator. The vortex is negative on the daily chart, but we're declining here with the green line and coming up with the red line. It's still positive since the green line's on top, but to see them moving in opposite directions is not very comforting. The Coppet curve is negative both on the daily chart and here on the weekly chart. And we broke below this 10-week moving average now. Okay, so that would equate to roughly a 50-day moving average. So we came down below this. We closed right on it a week ago. This was part of the convergence. And we started out above it, but then went down below it. If we continue to fall, we'll be watching this previous fib level, which is at the previous all-time high, right here at 48.14. And we're gyrating all over the place with our longer-term equity put call ratio. We saw a lot of hedging be put on things on Thursday, and then it came off on Friday. So we're getting some kind of weird signals there. We are going up with the VIX, and then we take a 3-month average of the VIX and do a ratio. That's going up. That's negative. Looking at our different trends, the Heikin Ashi on the weekly chart is negative with black candles. We're still positive with the Kigi chart, but now we're pointing down. Renko, what? Something's going on? We saw a sell-off? Nope, not according to me. It's still positive. Where the thin line break is now turning more negative. Ease of movement. We're getting extreme negative on the daily chart. We're rolling over, but still above zero on the weekly chart here. We're seeing some O's now. It took away that long, tall up. And now, since we've been coming down, we're seeing some O's being drawn in here, but no signal has been generated yet. Looking at our momentum, we're rolling over in the long and intermediate term. We're turning more negative in the short term. 50-day cycle, maybe there was something to it. We had a new 50-day cycle start about March 21st. We went up a little bit after that. It was just a few days after that that we set another new all-time high, and we've been just screeching to the downside ever since. We are negative with the Elder's Impulse system for the S&P on the weekly chart. We're negative for the second week now in the parabolic SAR. This was throwing up a big warning sign to me a week ago. This is an indicator that I have come to have quite a lot of confidence in. It was already negative on the daily chart, and the fact that we switched to negative on the weekly chart, that was a real warning sign, and that's kind of what ended up happening this past week. And then April is one of the more positive months. That's where we're at right now, seasonally. And then this just looks at the different indexes without any studies on them, where we saw a decline with the S&P, the mid caps, which are holding up a little bit better. The small caps have been going sideways. Of course, they had to see some weakness as well. The Dow dropping below its 13-week moving average, but still in an uptrend. And you're going to hear a lot of repetition. NASDAQ weekly chart below the 13-week moving average, still in an uptrend. NASDAQ 100, same thing here. And then looking at the QQQs, where actually I forgot to replace this chart. We've come down a bit here. Mid caps below the 13-week moving average, but still in an uptrend. Small caps still in an uptrend, coming down to possibly their 50-week moving average. NYSE, same thing, falling below the blue trend line. Wilshire was actually up on Friday, where it has been coming down underneath the moving average. All stocks dropping below their moving average. The biggest software companies dropping below this 50-week moving average. The FANG index, this is where a lot of the strength has come from. It's now showing some more weakness. ARC, which really didn't participate in the upside, it's sure participating in the downside now, where it was down almost 10% on the week. Looking at the banks, where they held up a bit better, we're above 50 and going back up with the RSI. The momentum is trying to cross over negative, but we'll see if that, it was actually up 2% on the week. So that may turn back positive. We are still seeing money going back into banks, which is showing more confidence there. This is just a plain chart of Dow theory. We never did get a confirmation. And the perma bears are just salivating over this, just screaming it as loud as they can. Well, it can take some time for this to work out. Now, at this particular point, yeah, that seems to be a big deal. But if we turn and start to go back up, we'll reevaluate things at that time. Where we did set a recent all-time high with the Dow, that was never confirmed by the transports. We were up this past week at the utilities, but we have been seeing some weakness. Broad market, CRB index. This is in an uptrend on the daily chart and here on the weekly chart. You have gold going up, you have energy going up, you combine it with all the other things, and we are now in an uptrend. Oil actually fell back a little bit on the week as things started to settle down. It really spiked up during the night when Israel attacked Iran, but then quickly came back down. Copper, since we're seeing strong economic reports or stronger than expected reports, this just suggests that the economy is looking better going forward, and it is in an uptrend. Here's the dollar, which we're seeing some strength here. Didn't see a big change on the week, but it has given us a recent golden cross. It's also positive on the daily chart. Gold, which is everyone's talking about, this is where you got to be. I was telling you all along, you should have been in gold. Well, it pulled back almost, I guess it was up 2%. We had one of those weird weeks the week before where we closed well off of the highs, and we actually closed up from there. Silver has also been strong lately, both on the daily and here on the weekly chart. Looking at interest rates, coming down to the 50-week moving average here when we look at the total bond ETF. This is bonds based on price. We're still outperforming when we compare stocks to bonds on a monthly chart, and we're actually looking almost normal here with the 1 month, and we subtract the 3-month yield. It was that way for quite a while, so I'm kind of waiting to see how that plays out. If you look at the overall trend here, interest rates have been going up, and that's putting some pressure on stocks. Here's a weekly chart looking internationally with US and UK rates being the highest, followed by German rates, and Japanese rates were actually down a little bit on the week. I've been showing this since last October. Are we headed towards 5% with the 10-year yield? That's where we hit last October and then started to come down. Now, other times we spiked, that could lead to some bad things. But there's other times, if you look here, you see spikes, and then we turned and came down. Nothing necessarily terrible happened during that time. So we just have to watch things. This also shows that same thing. When you look at real rates, that means you take inflation into account, where we've been coming down recently. Looking at some relative studies, we still have oil in the lead, followed by gold. And now you have dollar, the dollar actually doing better than stocks as they've been under pressure, where bonds going back to the beginning of the year are negative based on price. Now we look at some ratios. The NASDAQ 100 to the S&P, both have been under pressure, but before that, both were really doing well. We're still in an uptrend, but we're starting to see some weakness in this ratio. The S&P 100 is holding up fairly well when you compare it to the rest of the S&P 500. Growth, which this is when we want to buy low and sell high. That's when growth is outperforming value. We saw this ratio really come back this past week. And even though gold's going up, it's still in a downtrend if you compare it to the S&P on a ratio basis. But it's starting to break out when we look at the weekly chart here of gold compared to the dollar. And we're still underperforming when we look at bonds versus stocks, even though this is starting to turn back up slightly. Low volatility stocks really picked up in its ratio. It's really been underperforming. They're in an uptrend by themselves. They just have been really underperforming the S&P. Well, this is more defensive, and so a lot of folks are starting to get into these. And we don't know. Is this a short-term thing? Is this changing the overall climate? We kind of have to watch this unfold day by day. Discretionary versus staples. When this is going up, that's more positive for the market. We have been falling back here lately. Energy, which has been doing really well, it's still underperforming in the longer term when you compare it to the tech sector. And then our longer term look here, the NYSE breadth thrust, that's still positive, and that was generated back in October 2022. Now, this is interesting. We have the ZWAG NYSE breadth thrust. Over a year ago, we came down and were extreme negative and then shot up really quick and generated what's called a ZWAG NYSE breadth thrust, a very rare occurrence. Now that I say that it's rare, then last October, we came down and we're getting a negative reading and then shot up really fast. And so we saw another ZWAG NYSE breadth thrust. Now, this first one has pretty much fallen away. These tend to last for a year based on what I've been able to find. Looking how we're extreme negative here, if we get some kind of a solid upward move within a short period of time and send this baby all the way back up above the red line, that's going to generate another ZWAG NYSE breadth thrust. Purely speculation at this point. This is just something for us to watch out for. I look at this chart every day, even though I only show it in the weekly video. If we do start to see a new trigger be signaled here, then I will be talking about this in the daily video. But now, longer term with the NYSE Zohorchek method, we're still on a full-on buy signal. And we're still above this trend line going back to the 1987 crash. Looking at it on a bigger blow up going back to 2018, we're still above this line. Now, yeah, we're showing some weakness here. If we fall, will this area end up providing support? And then we're looking at the NYSE new highs minus the new lows, and then I take a 50-period moving average of that. When we're above zero, that's quite positive for the market. Lately, we've been pulling back. This is another measure only looking at the S&P 500. We're above zero, but we have been pulling back. And this is a little more negative right now. This is a weekly chart of the NASDAQ 100 going back to 2009. We've broken below this very long-term trend line. But when you look at this, this is the NASDAQ 100 to Dow ratio. And yeah, we're coming down here, but we're really near this really high reading that we were getting. And we were setting new all-time highs with this reading this past week. When we look at the Qs and compare it to small caps, because the Qs are doing better than the small caps, this ratio is going up. If things were really getting set to turn negative, we would see this ratio going down to the point where small caps, as terrible as they've been doing, they would be outperforming the NASDAQ 100, and that's not happening yet. We are still going up with our cumulative new highs, new lows for the NASDAQ, and we want to keep an eye on this 3-month yield. If it starts to fall, that could signal that something pretty major is happening. Seasonality, this is Dan Bird's chart where we're coming more into April now, where we're pretty choppy, but then we tend to see some more positive seasonality going into the latter part of April. Then we're also still kind of sticking with this. When we compare 1982 with what was happening in late 2023, we've actually been outperforming this, even though we're pulling back lately. Then when we look at every election year going back to 1950, the S&P is up 11 out of 18 times, 7 out of 18 times for the whole month of April, with a return of 1.3%. When you take all the Aprils from 1950 to 2023, we're up 71.5% of the time with an average return of 1.5%. We're also positive when you measure it different ways for the month of April. This is also showing how we are positive going back to 1950. And when you look at April, it tends to be the strongest month of the year globally, not just for the S&P or for U.S. stocks, but also global stocks. And then this is also put up by Carson, where the first part of April tends to be pretty bumpy. Yeah, try to tell people that as we go into the 19th here, where typically on a seasonal basis, we should be seeing some strength going into the latter part of the month. And then Tom Bowley, we're in that weak part of the month right now, where after the 24th, that will be Wednesday. So on Thursday, he'll have us coming back into a more positive seasonality. Thank you. I really hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.